Advisor David Kling, and we have a very special topic for you guys tonight. And in my opinion, in our company's opinion, this is one of the best exit strategies possible for real estate investors. This topic is especially relevant now that we've seen a great deal of appreciation over the last few years, and more investors are starting to sell their properties to tap into that equity that they have. And with that, the IRS actually requires you to work with a qualified intermediary to facilitate the process, such as asset preservation, who we have for you guys tonight. From Asset Preservation, we have the division manager, Kathy Bowenga, with us tonight on the webinar. And Kathy has some great deal of experience. She has over 30 years of technical experience in the commercial and residential title insurance and escrow industry. She has been with API for over 10 years now. And API, they've done over 150,000 1031 exchanges, and that is quite a lot. So with that being said, Kathy has done over 100 1031 exchanges with our network members personally, and has done a fantastic job. They've been a referral partner of ours since the early 2000s, and we've been working with API since the early 2000s. So we're very excited to have them on tonight for some great education. And if you guys have questions, feel free to write them in the questions box on the right side of your control panel. And I'll go through and answer some of those that I can, and we'll save a few at the end for Kathy to go over. But we have a great presentation, and actually our Vice President of Marketing, Scott Pastel, who many of you know, his younger brother actually worked with Kathy earlier this year to do a 1031 exchange to buy a property in Austin, Texas. So not only do we recommend her to our network members, but we recommend her to family and friends as well. So with that being said, I would like to present our 1031 exchange expert, Kathy Bowenga.
Good evening, everyone. Thank you very much, David. I'm excited to be speaking tonight because this year the volume of 1031 exchanges is really escalating. I think there is a definite perfect storm right now for many investors to look at Section 1031 as a way to limit their taxes, but not their growth potential, their ability to grow owning real estate and building appreciation and actually setting up their estate plan for future. So it's a perfect time to be doing this seminar. I'm going to talk about what really is an exchange. It's probably one of the most powerful tools available as a reinvestment plan, and it's been around for 92 years. Section 1031 has been around in the IRS code that long. And the tool allows owners who own investment property to defer. It doesn't mean eliminate, but it says defer state and federal capital gains tax, plus it also is a way of deferring your 3.8 Medicare tax if that is applicable in your case. So it's a way to defer paying a heck of a lot of tax when you sell investment property and use that equity to move up to a larger property to reposition your real estate so that you can get more cash flow, diversification, all kinds of really good investment strategies. And it's probably one thing that I tell all the members when I see them is that you have to think where you're going to be 5 or 10 years from now. So you need to have an estate plan. Think about, where you're going to own real estate. What's the diversification? You can own real estate investment property in all 50 states and exchange within all those 50 states. So there is huge potential in the residential and commercial markets nationwide. Taxes. Here's the first thing. The perfect storm that happened is taxes are only going one direction, I'm afraid, and that's up. Right now, if you sell investment property, you're looking at federal recaptured depreciation calculated at 25%. Federal capital gains tax is at 15%, but if you're in the high income tax brackets, making over $400 as a single person, $450 as a joint filer, your federal capital gains has gone up to 20%. So there are people, if you're in the high income tax brackets, you have just increased the taxes, the capital gains tax, by 5%. You're also, those people in the higher income tax brackets who make over 200 as an individual or 250 as a joint filer on their adjusted gross income are now subject to the Medicare surtax, which is a tax on passive investment income, which, I mean it, April 15th this year, once taxes were due in 2014, it is amazing how many people went to their tax advisors and, oh my gosh, they were hit with this, and they were just shocked. So this is something new that's happening, and it can really catch you off guard. Also, the state of California has certainly, it's pretty high. California is basically 9.3%, but it's bracketed, and it goes up to 13.3% for those people who have an adjusted gross income over $1 million, so they're paying 13.3%. So taxes have gone up, and it's kind of frightening when you look at it. You go, whoa, you've got to pay a lot. So what you as an investor in the Marshall Network need to do is you really have to think about what you're going to do when you go to sell a property and do the calculation, because if you don't have any capital gains to defer, you don't need to do an exchange. But if you have capital gains, that's where Section 1031 is so powerful. So I'm going to go through a calculation here. It says sale versus exchange, because every investor has a choice. You can sell the property and pay your tax, or you can do a 1031 exchange and take all that equity, move it forward, buy multiple properties, diversify, and do a lot of really fun things, but you've got to have something to defer. So this is an example of a property that I bought 10 years ago. The price of the property, or the basis when I bought it, was $500,000. During the 10-year period, I've put in on a new roof. I've done some improvements in the kitchen and the bathroom. So additional capital improvements totaled $50,000. Then over that 10-year period, every year, I wrote off $15,000 in depreciation. Depreciation is one of the benefits of owning investment property, because you can write off depreciation, your interest, and points. It's called the DIP. I call it the DIP, against your real estate taxable income. Depreciation you can't take on your primary residence, but you can on investment property. And in this case, residential depreciation is taken over 27.5 years. So each year, the value of the improvements on my property divided by 27.5 years can be written off over that period of time. So I've taken $15,000 off every year for 10 years, which totals $150,000, which has been a huge tax benefit for me. I add in the capital improvements, and I subtract the depreciation from my original basis to get my net adjusted basis. Now we're going to calculate capital gain. I'm now going to sell it for $1,200,000. What a great investment. I was here in Southern California, did a good job. But now I'm going to find out how much I'm going to have to pay. You take the sales price now minus the net adjusted basis, which is $400,000. You subtract the cost of sales, which is escrow, title, normal closing fees, and commissions are included. It was $80,000. My capital gains after I did the calculation is $720,000. Okay, that's my capital gains. Now I'm going to do the calculation. I'm going to pay 25% on the recaptured depreciation. So that's 25% of $150,000. Then I'm going to do federal capital gains, and I'm just going to say the top. Let's say I'm in the top bracket. I'm really not, but I am. I'm calculating it at 20%. Is $114,000. The Medicare surtax, if I'm in the higher income tax brackets, is $27,360, and my California taxes at 11.3, I went in the middle, were $81,360. On this sale, I'm going to pay $260,220 in tax. Whoa, that really is shocking, and it's unbelievable how it really adds up. So now I'm going to just calculate what I'm going to come out with. What are my net proceeds, and how does this all fit into exchanges? I'm going to sell my property for $1.2 million. I'm going to subtract the closing costs, and in this case, I have a loan for $500,000. Okay, so subtract the closing costs and loan balance. I get a gross equity of $620,000. Now I have a choice. I can actually pay the tax due, which is a $260,220, and my after-tax equity is $359,780. Now, I can then use that after-tax equity as, let's say, 30% down, loan to the value of the property. So I put 30% down. I get a loan for 70%. I can buy a property worth $1,199. Okay, that's if I sell it and pay the tax. But what happens if I use all my gross equity, all $620,000, and I defer the $260,000 in tax? So I can take all of that, put that as 30% down. I can buy a property worth $2,066,667. This is called the power of exchange, because here you can see how we're using all the gross equity, putting it down on a property, buying something in a better area with better rents, maybe less maintenance, diversifying, going into multiple properties, and building my net worth because I'm able to buy a property of much greater value. So this is the real power of a 1031 exchange, and being able to do this calculation is important. On our website, apiexchange.com, we have a calculator. So all of you, once you're considering selling, go in and actually do the calculation yourself. Get your tax return off and put in these numbers, and it'll give you a pretty good idea of how much tax you're going to have to pay. But as a golden rule, I think it's always wise, anytime you're going to do an exchange or sell a property, talk to your tax and legal advisor. Your tax advisor knows a lot about you. They know other properties you may own, businesses you have. They know a bigger picture. So on my checklist that you'll see that's on apiexchange.com as well, the first thing it says is always check with your tax and legal advisor and have them calculate exactly the amount you're going to pay. But you can see it can be quite substantial. So many investors seriously consider doing a 1031 exchange. What it says, and the code section is pretty clear. It says, no gain or loss shall be recognized in the exchange of property held for productive use in trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in trade, business, or for investment. It's a lot of words, but it says, I'm going to sell an investment property that I've held for investment. I've been depreciating it. I've been, putting in expenses and putting in my income and expenses, taking the depreciation on my income tax return, and I'm going to sell it. I'm going to follow some very specific rules and buy a property of like kind, which is also going to be held for investment. Okay, important. You need to buy a property which is like kind. And we're going to talk about that in a minute. It's investment property for investment property, okay? There are some things that you need to know that are exceptions to the rule. The first one I think is important because there are a lot of people out there right now that think that they can buy properties and immediately trade them or flip them. Their intent, the word intent is very important, is really not to hold for investment, but to buy the property, maybe fix it up, and then really quickly resell it. And they become a reseller, or what's called a dealer in IRS terms. If you're a dealer or your intent is to sell the property quickly and not hold it for investment, you are specifically exempt from doing a 1031 exchange. You cannot do it, okay? So be careful. Your intent must be to hold for investment. You cannot exchange stock, bonds, or notes and use Section 1031 to defer any gain, nor any other securities of indebtedness. And the fourth one is important. It's interest in partnerships or multi-member LLCs. I have some golden rules. My first golden rule is the same taxable entity that sells a property must be the same taxable entity that purchases the replacement property. So if you own your investment property in a partnership, you sell in a partnership, you buy in a partnership. If it's in a multi-member LLC, Multi-member LLC is what you buy in. If you buy as individuals, you buy as individuals. If you want to exchange an interest in a partnership or an interest in a multi-member LLC, that interest is considered personal property and not exchangeable. I get a lot of calls from people who 3 people get together and form a partnership, and one of them doesn't want to go with the other 2. We have a problem because the partnership has to sell and the partnership has to purchase the replacement property. It must be in the same taxable entity. And the reason for that is everything is tracked through the tax ID number. And a partnership or multi-member LLC has a different tax ID number, and so the IRS tracks all 1031 exchanges through that tax ID number. So, important note, golden rule, same taxable entity that sells must be the same taxable entity that purchases. Another exception to the rule is if you have a note and you've lent somebody some money and they pay you off on the beneficial interest on a note, you receive that money, you cannot defer any gain on that note in a Section 1031, nor chooses an action, which is it's a French term that has to do with if you acquire property in a judgment. Like if you sued somebody and you got a property through a judgment, in many cases you could not do a 1031 in the future. Okay. Intent to hold for investment. I use that word. It's so key. Time is only one factor, really, in proving your intent to hold for investment. There are a lot of facts and circumstances involved. So if you were ever asked, how long do you have to hold a property under Section 1031, you could actually say there's nothing in the code section that says really how long. That's why it's kind of a gray area. Time is only one factor. A lot of it is based on facts and circumstances. However, practitioners look at 2 perspectives. The one is owning a property 24 months. And that's because there was a private letter ruling, which is very specific to a specific case in 1984, so it's been a long time ago, that said 2 years was sufficient. So many practitioners go back to that. And they also look at a more recent revenue procedure, which is very specific, which provides a safe harbor and vacation home guidance, which was in 2008. It's called Revenue Procedure 2008-16, which said you had to own a property 24 months before you sell it. You need to have it on your tax return, those 2 tax filing periods, and then you have to buy a replacement property and again hold the property for 24 months or 2 years and have it on your tax return as held for investment. So that's a pretty conservative perspective, but 24 months is certainly, I think, pretty defendable. The second perspective is a more aggressive, but Southern California practitioners usually say, hold the property for at least a minimum of 12 months, because if you own a property for the first 12 months of ownership, if you sell it, it's short-term capital gains, and you would pay tax at your ordinary income tax rate. You must own a property over 12 months to be in long-term capital gains, to be in the 15 or 20% bracket. So owning a property minimum of 12 months is pretty critical. But if you own a property 12 months, you can straddle 2 tax filing periods showing income and expenses and depreciation in those 2 tax filing periods. It's a more aggressive perspective on it, but I do find a lot of people will own it for a little less than 2 years and be in between 1 and 2 years and do proceed with a 1031 exchange because I have a paper trail. I'm married to an auditor, and paper trail to paper trail. Okay, like-kind, it makes my job so exciting, and that's because like-kind is really broad. It's investment property for investment property. So you could have a residential home and you can sell it and buy a duplex. You have a duplex and you can buy an apartment building. You have an apartment building and go to a commercial building. From a commercial building you can go to 2 shopping centers. It's any real property that is held for investment. What is not like-kind is your primary residence. You cannot exchange an investment property into your primary residence, and also you cannot exchange outside of the country. There are some exceptions for U.S. territories in some particular cases. Guam and the Mariana Islands have been added in, though, however. You can exchange there. But what you can't do is exchange for property in Mexico or Canada or another part of the world. Okay, that is not like kind. And also, you cannot exchange real property for personal property. So you couldn't sell that farm and that farmland or that the winery up there on the top of the picture and buy an airplane, because that would be real property for personal property. It must be real property, real investment property for real estate investment property. But it's very broad, so I have a lot of fun stories of people who got out of the box and did all kinds of things. And it's in all different locations within the U.S., so you're not confined to a geographic area. You can go anywhere in the U.S. Okay. The second golden rule in a 1031 exchange is that for 100% tax deferral, you must meet two requirements. The first one is you have to reinvest all your net proceeds. So all the cash at the bottom line of the closing statement you must use to buy the replacement property, and you must acquire a replacement property with the same or greater debt. So let's take an example here. I'm going to sell a $900,000 piece of property, which I have debt of $300,000. My closing costs, that's commission, title, and escrow fees, closing fees, settlement fees, $60,000. So my net equity or cash coming out is $540,000. I'm going to go and buy a replacement property for $1.2 million. I'm going up in value. So luckily I'm putting on a lot more debt. I'm going to have $660,000 of debt. And I'm going to use all my net proceeds, $540,000. There is no boot here. And a lot of you have heard boot, or a good kick in the pants is when in an exchange you take any cash out or get cash after you've done your exchange that's left over. That's called cash boot. It's cash that you're going to put in your pocket. Or any mortgage relief that you have. If you go down in debt on your mortgage on the replacement property, that also is called boot and is taxable to the extent that you have a recognized gain. Okay? In our case here, we have no boot. This is a 100% tax-deferred exchange. They've used all their net equity and bought a property of equal or greater debt. In the next example, kind of a red flag. As you can see here, I'm buying a property of lesser value. Nothing's wrong with this. This is called a partial exchange. But it's kind of a red flag. It says to me, oh, they're going to pay tax somewhere. And obviously, looks like they're only going to put up $440,000. So they have $100,000 of cash boot. They're not going to have as much debt. They only have $260,000 in debt, so they have $40,000 in mortgage boot or mortgage relief. They have a total of $140,000 in boot, and that boot is taxable to the extent they have a recognized gain. So on that $140,000, I really recommend, if you're buying down in value, probably do talk to your accountant, have him calculate exactly how much you're going to have to pay. But you can offset that $140,000 with passive losses that you may have been rolling over on your tax return on a yearly basis, and that boot could be offset by those losses. So talking to your tax advisor is a wise idea, but it's called boot, and it is taxable to the extent you have recognized gain. Okay. Delayed exchange process. Okay. The IRS says, you're the taxpayer, you're our investor, you're the owner of the property, and in Section 1031, it says very specifically that you can't have receipt of the funds at time of closing when you sell your relinquished property. It's actual receipt and constructive receipt. That means even if it closed and you haven't cashed the check, you have constructive receipt, and that's your money. And if you take the cash, actual receipt or constructive receipt, you have a taxable event. And the way that you can avoid that in an exchange is to work with a qualified intermediary, which is asset preservation, to hold your funds during the exchange period by going through some specific rules and procedures here. We have a case here where we're going to sell a property and we're going to buy and purchase a replacement property. You, our Marshall Reddick investor, are the taxpayer and you're going to sell your property. Once you go to list the property, you need to make sure that you have a purchase and sale contract that is assignable, because that's how an exchange works. We are assigned in on behalf of you on the purchase and sale contract to sell your property, hold your funds. Then once you go to buy a replacement property, we're assigned in on behalf of you to purchase that replacement property, use your funds, and buy that replacement property. And through the use of what's called direct deeding, which is allowed in the exchange agreement, the escrow officers or the closers, settlement closers, attorneys, prepare documents such that the deed goes directly from you to the buyer and directly from the seller to you on the purchase of the replacement property. But there must be an assignable purchase contract. Once you go into escrow, you would call a qualified intermediary such as myself, because you must have an exchange agreement in place prior to close of escrow. In the state of California, closing is as the date of recording. In other parts of the country, there's what's called an Eastern close or a table closing, where you can close and the cash passes, there's a settlement statement, but the deed doesn't record for 3 or 4 weeks, okay? In that case, it is the day that the funds pass. It's the settlement statement that determines day 0, the date that you specifically have purchased the property, because that's when funds have transferred. And that is the day of closing. You have 180 days from that day. And if it closed today, tomorrow would be day 1. You'd have 180 calendar days, or the day your tax return is due, whichever comes first, to purchase your replacement property in a 1031 exchange. It is calendar days, so it includes weekends and holidays and everything like that. It's usually people, very rarely we have people that aren't unable to close within the 180 days. But what's key here is we close escrow. The net proceeds come to the qualified intermediary. You have 45 days, however, to identify. And that means if you haven't purchased your replacement property in the first 45 days, you must identify on the 45th day the property or properties you're going to purchase within the remaining 135 days. There are a lot of people that will purchase their replacement property in the first 45 days, and that's considered identification. But with low inventory, as the market seems to be picking up, 45 days can be a click of the fingers. It can go very quickly. So you need to be out there looking for replacement property so you're not making quick decisions. Do some planning, be prepared. Okay. Hopefully you have been out there looking, and you've been, by the 45th day, you're in escrow on a property, you've done the due diligence, you know, you've had all the inspections made. So you identify that property on the 45th day, and you're able to purchase it within the remaining 135 days. There are some identification rules we'll go through here in just a few minutes that are very important. But in this particular case, you identify it on the 45th day, you purchased, let's say, on the 110th day. The closer on the purchase replacement property lets us know you're closing. We send them your net proceeds, and they close and execute a direct deed directly from the seller to you, the taxpayer, or the Marshall Reddick investor. This is, I think, a pretty clear diagram of what happens. And if with good planning, it goes quite smoothly. But the identification rules are important to note. And one other thing, as we're getting towards the end of the year, I think you heard me say you have 180 days or the day your tax return is due, whichever comes first. At the end of the year, if you close, let's say on December 1st, that'll be in 2014, but your 45th day will be in 2015. And you identify in 2015 and April 15th comes around and your tax return is due, however you haven't purchased your replacement property. If you are still in exchange, have not purchased your replacement property, you must file an extension on your tax return to give you a remaining 6 months to file a tax return in the same tax filing year showing the sale of the relinquished and the purchase of the replacement property. So as we get down to the end of the year, this does become critical. API lets every investor know we are on that in a flash, and we will make sure that you file an extension on your tax return because it could invalidate your exchange. Okay? All right, the identification rules are 45 days to identify, and that's from the date of the sale of the relinquished property. It is calendar days. The 180 days are the total days that you have in which to close on the replacement property or properties. On the 45th day, if you haven't purchased your replacement property, you must identify. And there are 3 rules. The first rule is the 3-property rule. You can identify 1, 2, or up to 3 properties of any fair market value. This is the most popular rule. I would recommend, if there is any question that a property looks a little shaky on the 45th day and might not close, many investors will identify more than 1 property. They'll identify some backups just in case, because things do happen. So the 3-property rule is the most common rule. However, what if you have 5 properties that you're looking at? And you go, oh, I like all 5 of these. I'm actually selling a big property, and I'm looking at buying more than 1 replacement. The 200% rule allows you to identify more than 3 properties, but the fair market value of all the properties identified, when you add up the values, they cannot exceed 200% or double the value of the property that you sold. Okay? This has been used quite a bit lately. Where we have exchangers that are selling larger properties, and they're going into single-family, multi-family, or smaller single-family residences. Like they'll sell apartment building, and they'll want to go into the single-family resident market, and they'll sell a big building, and they'll buy 3 or 4, maybe 5 single-family homes. So if you're buying smaller valued multiple properties, the 200% rule works. Now, what if you have 5 properties and they exceed the 200%? You then can default to the 95% rule, but this is pretty hard to do because you have to buy 95% of the total value of the properties you have identified. It's very rare. Most people do not do it, but it is available. Okay. The identification rules. On the midnight of the 45th day, you must send an identification. It needs to be in writing. You need to unambiguously describe the properties by APN number, address, or legal description. It can't just say everything in the MLS in Houston or something like that. Before 1984, you could do that, but since 1984, you can't do it. It has to be quite specific because if there's an audit, they want to be able to go and look at the property. It has to be hand-delivered, mailed, telecopied, or otherwise sent to the person that's holding your funds. Usually it's a qualified intermediary, or it can be a party related to the exchange who is not a disqualified person. Once in a while, we will have someone say that they have identified with a party who is related to the transaction, who is not disqualified, and a disqualified person would be a related party. That would be someone related to you ancestrally, mother, father, sister, brother, or a attorney, CPA, real estate agent, anyone that's had a contractual relationship with you within the last 2 years. So it's pretty hard to find someone who's not one of those involved with the exchange, but once in a while people will identify with someone other than us, the qualified intermediary, and we ask for a hold harmless statement from them that they will not hold us harmless. They hold us harmless and there's an audit because we did not receive the identification form. But those are the rules. Exchange documentation. What do you get? Okay, you're gonna call me and we're going to get a copy of all these documents. We're going to email you We do everything electronically, an exchange agreement, which outlines all the rules very clearly and specifically states that we are restricting the use of your funds during the exchange period because you can't pledge, borrow, receive benefits of those funds. So it's a very clear agreement. And it says you're signing your interest in that property. So API is basically becomes the seller. We sell the property for you. We hold your funds, and we're signed in on behalf of you to purchase the replacement property with your funds through assignment. So it's very clear our role. There is an assignment agreement, so everyone, you're clear that we've been assigned in and that there's an assignable purchase contract. There is a notice of assignment which will go to the other party. If you're the seller, it goes to the buyer. If you're the buyer, it goes to the seller. Just notifying them that there is an assignment because we are a party to the transaction. There's an account setup form which asks for your Social Security number, information like that, and the security of funds instrument, which is so you know the bank and institution your money is going into. There are normal closing entities, settlement forms, and this is kind of interesting. Each state has different withholding rules. So one of the things about API is we're in all 50 states. We do transactions everywhere. So our exchange counselors are very familiar with the withholding rules in every state. Some states are very strict, not only on federal withholding, FERPTA, but on state withholding. For example, Maryland is very strict and has some special rules. California has its own special rules. So where applicable, those do apply. Closing entity forms to 1099, we will ask you to sign a 1099 form. And any other documents that are common in your area to close a property are appropriate. There is such thing as a multi-property exchange. It's extremely valuable, and this is a good Marshall Reddick tool. I've seen this happen before with some of the investors, is that they have 3 single-family homes, and they've owned them for many years, and they want to go into an apartment building. They want to move up, possibly into new construction, an area closer to their home, better cash flow, all those things. You can do a multi-property exchange, but you just need to know that the exchange starts when the first property closes, because you're putting all the equity and debt together on all 3 properties to purchase the one replacement property, and the timeline starts when the first property closes. So timing is critical. I usually recommend that you close on the sale properties, the 3 properties you're selling, within the first 45 days, because then when you identify, you know exactly what cash you have and what debt you have to replace on the replacement property. So identification becomes much, much easier. But we do a lot of multi-property exchanges. Last month I had a lot of them. It's just amazing, especially similar to this, 3 properties buying 1 larger property. Okay. The reverse can also happen where you have 1 large property and you end up buying multiple replacement property. Last year I had a very interesting exchange where a taxpayer sold 1 single-family home for $3.5 million, but it was in California, the property, but they lived in Pennsylvania. And they had no debt on the property, so they had $3.5 million. They decided to sell that property in California, and we did the exchange, and on the 45th day, they used the 200% rule. They identified 47 properties in 13 states totaling $6.9 million, which was just under 200% or double of the sales price of the $3.5 million home they had in California. They identified 47 properties in 13 states, and they purchased 31 of them in 11 states in the remaining 135 days. Most of them were on the East Coast, closer to where they lived, and they increased their cash flow by 253%. So multiple property exchanges are common, and it's those are truly investment strategies that that kind of get out of the box, and that's why I'm sharing it with you. Okay. Let's go to today's market. Just want to review it. There is low inventory, so you really need to plan. If you're going to be selling a property, the last thing you need to do is sell it, get into escrow, and not have a plan. You don't know where you're going to buy, and that's the benefit of the Marshall Reddick Network, is they can help you locate areas that fit your financial plans here. But you need to let them know early on. The worst thing that can happen is you've already closed on your relinquished property. You only have 30 more days to go, and you call, what do I do? So planning is important because inventory is low, because people are looking for cash flow properties, and it can be challenging. There is such a thing as a reverse exchange. Many investors are concerned about the low inventory and the fact that they may not find a replacement property, so they take advantage of a 2000 revenue procedure, which provides a safe harbor where they can go out and purchase the replacement property first and then have 180 days to sell their relinquished property. It is sophisticated to do, and it is much more expensive, but if you have cash and you're credit worthy, it is an option. Another thing today I find in today's market is a lot of people don't want as much debt, so they're doing partial exchanges. They're selling their investment property, and on their replacement property, they're going down in value and just taking some debt relief, some boot. They're just paying boot on that debt relief or mortgage relief, and paying a little tax. And maybe they have offsetting losses, so they end up not paying any tax at all. But partial exchanges are common right now, also because lenders are requiring more cash down. So a lot of times you have to make exceptions, either bring in cash or actually go down in value. There are investor versus dealer issues. Be careful. Don't become a dealer or reseller because you won't qualify for a 1031 exchange. Always make sure that you're reporting income and expenses on your tax return and taking advantage of the depreciation. I had one guy tell me one day, said, oh, I didn't take depreciation because I know I'd have to pay it back when I sold the property. That's not true. If you don't calculate it, the IRS is going to calculate it, and they're going to take the money whether you took it or not. So make sure you take advantage of the depreciation. Loan over basis. I haven't seen it lately. 2 or 3 years ago, there was a lot of this where people refinanced over their basis or what they bought the property for, and then when they sold, they didn't have enough cash coming out of it to even pay the tax. So, but that's not happening. But be careful when you refinance it. If you're going over your basis, you really know what you're doing. Okay. Also, California did pass AB 92. Interesting. A lot of people are tracking where you buy replacement property. In the state of California, when you file your tax return this year, if you sell in California and go to another state, you will be filing a new form on your tax return. It's called 3840. It hasn't come out yet, but they want to know where you're purchasing replacement property, and they will be tracking it so that at a later date, if you sell and don't do exchange, they're going to be able to claw back the tax that you left on the plate. You didn't pay in California when you did your exchange to another state. Okay. Processing your file. We do a lot of things. We interface with the closer and with you. We confirm all your entities. We make sure that you comply with the 45 identification period. We answer questions throughout the entire exchange. And work with your tax advisor. They can call us, ask us questions. We also notify any of our clients of legal updates. You can go on our website, apiexchange.com, and you can subscribe to our e-news. All you do is put in your email address and subscribe to our email news, which comes out every month. It's a great newsletter, so please make sure within the network everyone you know goes and subscribes. There's no cost, nothing. Just put your email address in and you'll get it every month. We also provide the clients a summary of the whole transaction at the end. So you see all the dates of the sale of the relinquished, purchase of the replacement, summary of incoming, outgoing wires, so that's all included, so that you take it to your tax preparer and complete the 8824, the form for the IRS. Okay, due diligence is real important when you select a qualified intermediary. We are not a regulated industry. Okay, there are people out there that are working out of their garages. They are not bonded. They have no insurance. So it's real important you know who you're working with, because a qualified intermediary or accommodator, facilitator, there are a lot of names for us. We had a lot of money, hundreds of millions of dollars every day, and you should know, exactly how they're holding their money and what are their qualifications. What is their fund management? Do they conduct due diligence and monitor the deposits? We only use grade A banks. Our parent company is Stewart Title, and they're on the New York Stock Exchange. We're totally transparent, and they select the banks which we deposit your funds in a money market account into, only because we're the only company in the U.S. Right now that has a third-party guarantee. They will guarantee your funds during the exchange period because they know what bank, and they select that bank. Whose name is on the funds? Make sure that they're segregated accounts, that your name is on that account. It's to the benefit of you. What are the requirements of deposits and withdrawals? We require 3 signatures of 3 separate people for all deposits and all withdrawals. We are very strict, and upon request, you can ask specifically that without a written signature and no withdrawals or deposits can be made. Is the QI audited? We are independently audited by KPMG twice a year. So we have a third-party auditor, and we do adhere to state laws governing qualified intermediaries. We are domiciled in the state of California. Here's a picture of me. Now you can see my mugshot here, what I look like. I'm located in Carlsbad, California, but we have other division managers throughout the country. I want to thank you for listening to the webinar and being here today. I'm now going to take some questions, and I'm going to turn it over to David and see if we can answer your questions and continue our conference call.
All right. Thank you very much, Kathy. That was some great information, and we definitely have some questions here. I wanted to tell everyone, some of you who know me that I see on the call, a lot of familiar people. For those of you who don't, I'm a real estate advisor here at Marshall Reddick Real Estate Network. So I work hands-on with our clients here. I get to know you guys very well, learn about you, and your current investments, what your future investment goals are, and I work with you to really achieve your financial goals in life. So with that being said, I wanted to get to the questions that people had here, and as I'm going through here, I see a few. The first one that we had here was, Kathy, can you exchange a primary residence for another primary residence?
It's not an exchange. A primary residence, the taxes come out of Section 121 of the Internal Revenue Code. Section 121 of the Internal Revenue Code says if you live in a property 2 of the last 5 years, you as a single filer can take $250,000 in capital gains exclusion. The first $250,000 are free. If you're married, you can take $500,000 free. So as long as you live in the property 2 years as your primary residence, you sell it. In most cases, most people don't have over $250,000 or $500,000 in capital gains. They don't have to pay any tax. There is no exchange. You just sell your property, put the money in your pocket, and go and buy another property. Okay? The only time you would do an exchange is if you had a property where, let's say, you had over $500,000 in capital gain and you were a couple. let's say you had $1 million in capital gain and you moved out of that primary residence and rented it for 2 years and then sold it as an investment property, but you lived in it 2 of the last 5 because you moved out 2 years ago. That was your primary residence before, so you moved out 2 years ago. Now you're renting it, but you lived in it 2 of the last 5 years. But you're selling it as investment property. There is a revenue procedure that allows you to sell that property as investment and take advantage of both sections of the code. And in that case, you could take the first $250,000 or $500,000 of that exclusion, take it right off the bottom line, put it in your pocket, and then the remainder, because I told you had $1 million gain, that additional $500,000 could be exchanged. So you can actually use both sections of the code. But that would be the only time that would come under, that only would work. Because most people don't have over $250,000 or $500,000 unless they're in a pretty high income tax bracket or in a very highly appreciated area.
Mm-hmm.
So they don't do an exchange. You can't do an exchange on a primary residence.
Gotcha. Yeah, we have another great question here. What happens when an LLC, specifically out of Utah, is formed with a partner and that does not correctly complete their 1031 exchange or does not pay their capital gains? Will the LLC and the investments be held liable or affected in any way?
Let me see if I understand that question. You owned a piece of property in a Utah LLC and there were multi-members, and you sell it and you're not filing a tax return and you're not paying any taxes. What happens? I guess I have to say the IRS could audit you or what have you if they find you. You should file your tax return. So I guess, yes, if you owe taxes, they're going to find you. Whether you but yeah, if you owe taxes, that LLC they'll come after you for the taxes if you owe it.
Gotcha. And then you said there was an exception for some overseas sales for the 1031 exchange that you had mentioned. Which particular areas were those overseas?
Guam and the Mariana Islands have actually been included into Section 1031. There are some U.S. territories that are down in the Caribbean, specifically down in that area, which are U.S. territories. They are private letter rulings that are very, very specific, and most of them apply to personal property or businesses. And I would recommend having the taxpayer call me, and I will refer them to an attorney that can specifically review the private letter ruling and see if they fit into that private letter ruling. But they're in the Caribbean area. They're U.S. territories down there.
Very good. And then we'll take one more question here. And what I was saying was, how much is the process of the 1031 exchange? Is it depending on the amount of the exchange, or is it a fixed amount?
Okay. The code section says that we can charge a base fee, and then we can earn some interest on your money during the exchange period. So that's kind of how we make our money. Because we're holding a lot of money, even though interest rates right now aren't even 1%. There's not much money in it, but we actually have a base fee. Once you open an exchange, we prepare the exchange agreement. We email you your documents. You sign them. They do not need to be notarized, but they must be signed prior to close. At closing, once we receive your net proceeds, we will take out $700, okay? And we will, as a fee for the sale, okay? Once you decide on the 45th day to purchase replacement property, we charge $300 for up to 3 replacement properties at the time of purchase of those replacement properties. So it's $700 for the sale, $300 for up to 3 replacement properties. So It's basically $1,000 to do the transaction. If we're holding $1 million, there will be some interest you may earn on your money, but we have to hold over $1 million. So
well, very good. Well,
just one other thing: we do not have any junk fees. We do not charge wire fees. We do not charge any setup fees, any cancellation fees. Nothing. There's nothing like that. Which you need to be careful about, and that's a question you always need to ask, but we have none of those fees involved at all.
Very good. Well, thank you very much, Kathy, for your time here, and we all definitely appreciated you explaining and answering all those questions, and that was a fantastic presentation. I learned a lot from it myself. Everyone who's on tonight, you'll also be sent this presentation tomorrow, so if you might have missed something throughout the presentation, no worries. Keep an eye out on your email, and we'll be sending you over this recorded webinar in the morning. But that'll do it for us tonight, and thanks again, Kathy, and have a great night. Marshall Reddick Numbers.
Thank you, everyone, for joining us. Good night.